Lakshman, welcome back.
Thank you. It's great to be here.
It's been almost 2 years since we met in an apartment in New York with the furniture piled up on one end of the room, trying to make this thing look half professional. and we managed it then, and now we've got a bigger room. So hopefully this one will be even more professional.
There we go. You are on an upswing.
Well, let's hope so.
There
let's
you
hope
go.
so. Well, talking about upswings, this is what we're going to talk about
Yep.
today. You know, you guys do some of the best work on cycles anywhere. And, you know, Raoul is a big proponent of the business cycle. He's kicking me because I get to do this one today. So I want to get a sense from you of where you think we are in the business cycle. There's so much debate about this.
Sure.
What's your work telling you?
Pretty crystal clear. We're in a growth rate cycle upturn, meaning the coincident indicators that define the economy, the broad economy, have been, as a group, growing faster since the middle of 2016. And our forward-looking indicators on the broad U.S. economy say that's going to continue. The forward-looking long-leading index says that'll continue. So there's no recession this year. We're always watching. Once we're in an upswing, we have to be. The next thing is when's the downswing start. So we're always watching, and there are a couple clouds on the horizon. But for the next several months this year, I think we're in an upswing.
So where do you see, when you see all this talk about the disconnect between the soft data and the hard data, the sentiment and the actual numbers? Does that factor into your work? And if so, how do you guys think about that?
So we don't think about it. The short answer is we don't think about it. I think that's a somewhat kind of contrived debate about the angst of the economy or the market going in the way that you don't want it to or don't expect it to.
Right.
These indicators, just to be clear, our leading indicators, our coincident data, they don't change.
Yeah.
These things have, it's not like the drivers of the business cycle change from year to year. They don't. And in fact, when we go out of sample backwards in time, they work quite well going the other way too. So they've been running real time for decades, out of sample real time kind of performance very well. And when you look backwards, they run very, very well. They exist kind of pre-fed, these indicators, which is interesting to note. They've worked during the depressions, not even before the Great Depression, so all those jungle variety business cycles they worked in. So they worked very well in 2007-09 financial crisis. And one thing I think to keep in mind about our indicators is the primary piece of information that they are giving is the risk of a cyclical turn, up or down, either way. That is their reason for being. In terms of the magnitude of the move and other things, that's kind of a secondary factor, but the primary piece of information is the cycle upturn or downturn, and there's two cycles to think about. There's the big 800-pound gorilla recession, which is when the level of activity falls, or you have negative growth rates, or in recessions and recoveries, and then there's growth rate cycles, and I started off talking about a growth rate cycle upturn. So that's an acceleration or a deceleration in growth. Those are the two cycles that we're looking at.
Yeah, when you boil it down to that, and you look back over time, there's this idea that human beings, and as an extension, markets are cyclical. It's such a simple premise to understand. It's a simple premise to backtest. And it's really hard to argue about that. We all know that we are cyclical beings. But yet, this idea of there being a business cycle is still hotly debated, which strikes me as ludicrous, frankly.
Yeah, we wrote a book a long time ago in 2004 talking about what happened here. Because, mind you, I'm the third generation, and it's not me. As my colleague Anirban Banerjee and our whole research team are the third generation of this work. We were taught by my mentor, Jeffrey H. Moore, the father of leading indicators. He was taught by his mentor, Wesley Mitchell, who defined what a business cycle is. I said the coincident index, I said it very quickly. It's broad measures of output, employment, income, and sales that move. They have co-movement at peaks and troughs in the cycle. And those are driven by fear and greed, inventories and credit, and, stuff. These they make sense. And that all used to be the way. When Wesley Mitchell wrote a book, it was The Business Cycle, The Problem and Its Setting in 1927. Seminal book. This defined things for people. That was the way people thought back then. They were dealing with recessions and recoveries, big, huge jungle variety ones. Then post-war, I think you have in academia, there's fads and fashions, and there was a lot of envy among economists that they were not considered a hard science. So we call this physics envy, right? And they were going after, hey, I want a Nobel laureate too, and all of these things. And a big move to, hey, we can make a model. We can throw more stuff in it. We can reduce it. We can torture this data. We can fit it perfectly to the last 10 years. And it keeps breaking when it tries to forecast, but they don't stop doing it. And that's actually the way 9 out of 10, and I'm being generous, is probably more, forecasts are made by extrapolating recent trends. And that works fine if you're not near a turning point.
Exactly.
And when you're at a turning point, you end up being, what is it? It's the coyote following the roadrunner.
Yep.
And you know how that ends.
Exactly right.
At the turning point, he's always over the cliff.
Yeah, exactly. But and yet, to your point, they adhere to this almost religiously, this belief that if we just tweak the model,
orthodoxy,
we'll get it. It was just one more tweak.
We missed it. Last time we didn't get the behavioral stuff in there. Oops, we're going to add that
but
in.
They miss it every time. That's the extraordinary thing. They miss it every time. And
but if you miss it as a group, then you're relatively fine.
Yeah,
and that's kind of what goes on. There's this orthodoxy in all kinds of places, including central banks, which is dangerous because they are driving monetary policy.
Yeah, but your indicators, they are so simple, right? These are basic, old school indicators in terms of the components. It's a very straightforward way of measuring these things.
They're simple. It's easier. I remind people I'm not an economist in that sense. We don't use econometric models for our cyclical forecasting. And rather, I describe myself as a student of the business cycle. And I think with a little bit of time talking like this, pretty much anybody can understand what we're doing. Probably the ones that have the most difficulty understanding what I'm saying right now are economists.
Yeah.
And I have sat in presentations where I thought I was being very clear and spoken past someone for more than an hour or so, because at the end of the question is, okay, so how's the regression work, or how does your model work? I'm like, we don't do that. We call ourselves monetarists with an I.
Okay.
We monitor the cyclical indicators. So the coincident index is the target. Output, employment, income, sales, put it together, you can see the fluctuations. Now we look at the leading indicators. So it could be something as simple as new orders. Mm-hmm. New orders should lead production, right? You don't have to be an economist to figure that out.
This is not PhD stuff here, right?
Well, but you'd be amazed, right? And so, but then how to do that? There are some intricacies on how to do that and keep it honest in how you're doing it and not fit it and so on and so forth. But that's the general concept. And so there's coincident data, there's leading data. So new orders, PMIs, stock prices, that falls into the leading data. We actually call them short leading indicators. Then there's long leading indicators that lead by another quarter or two. So we'll look at them sequentially. A long leading turns, then a short leading, then the coincident. The consensus, kind of the headlines, like what's going on right now, whatever the headlines think are going on, they will live somewhere around coincident data to slightly leading, right? Because people do watch some of that slightly leading stuff. The PMIs are very influential. Stock prices can be very influential. But those actually are confirmatory for us after seeing the long leader move. And as they move, we know they move in sequence at turning points, not away from turning points. That builds our conviction so that when you see the turn start in the coincident data, I think most people are saying, that's probably noise. And I'll look at it with the benefit of some of the indicators and say, there it is, right on time.
Right. But you trust those, right? And that you've grown to trust them.
I trust them. I was going to go to Wall Street, 1990. I went up to Columbia. I was going to Wall Street for interviews and to Columbia University for interviews with Jeffrey Moore, my mentor. And as some may remember, there was a recession, 1990-91 recession. And so it's a relatively mild one, but by what we've just seen. But being in the front row seat for that with Dr. Moore, I was like, I found my calling. I am so lucky to find something this interesting and to see it happen. Typically, when I start working with people or whatever, or talking to them, or they get interested in what we're doing, it's after they've been kind of run over by a bus at a cycle turning point. And they say, well, how do I avoid that again? And you might find yourself moving away from models and toward considering cycle indicators too.
See, I find this fascinating, and I want to ask you about this, and I've spoken about this before. The fact that you found yourself in that world right at one of those turns, how do you think that shaped you? Because if you'd joined in 92, you'd have watched this stuff and learned about it and seen kind of nothing happen for 8-9 years until the 2000-2001 recession. So how do you think the fact that your timing of walking into this world has shaped the way you've kind of developed in it?
I think it was pure luck,
obviously,
no, of course. And I think it shaped it because it's hard for me to convey conviction. I just spoke about there's a global industrial growth downturn that's going to happen, and I'm pretty darn sure it's going to happen. It's already just about starting. How do I convince you of my conviction? Right? I can show you the charts, which we could do, but having lived it and experienced it, I can actually do something and kind of act on it, take an action. Okay, we're going to do this, we're not going to do that, based on those expectations. We were working with a heavy machine, an industrial company. And this was in 2003. I'm getting this, and our leading indexes had taken off to the upside. And they were relatively pessimistic. I think these surveys, the soft data surveys of the CEOs, was like half of them thought that there might be a recession or something like that. And so we go into a huge corporation and we're like, yeah, go for it. Right. And the corporate, they're like, what? Wait, no, we have to be careful. So they nudge it a little bit, right? And they probably up production a little bit, as you do, right? You just come a little off of where you might have otherwise been based on your model. And then a couple of months later, we're there, and we're like, hey, let's see this stuff, because we always talk about cycles and charts and this and that. I was like, I want to see the product.
Yeah.
And we go out to the loading bay, empty. They're like, yeah, we didn't make enough. They left a lot on the table. But that kind of conviction you can't get from me just telling you. You have to experience it.
But and you have to live both sides of it to understand that it really works. If you've lived through a thing telling you the cycle's turning, it's going up, but you haven't seen that it works to the downside, until you see it work, it's
so more contemporary stories like that. So we obviously have the Great Recession. That's a big call, probably. But buried in there, in the 2007-09 recession, is our upturn call, which we make by early March of 09, and definitive.
Yeah.
It's kind of binary, our stuff. It's going up or it's going down. If it's pronounced, pervasive, persistent, it's objectively moved, that's the call. And we make that call, and there's a G20 meeting in April, and everybody, politicians try to be optimistic. Mm-hmm. They're all talking about depression.
Yeah.
And we got in a little tiff with Krugman about this, and so on and so forth. And we're just like, yeah, that's what it is. And in fact, the first year is going to be sharp. But after that, no, because of the structural problems, right? So huge policy error, right? Because the V shape doesn't continue. Remember, I think Obama had the recovery summer and these kind of things. This is all old news at this point. But those were all of that V going back to the low trend growth that we have. And fast forward to late 2011, we make a recession forecast for 2012. So up until then, gosh, I got to tell you this really quick story. The Economist magazine does a story on us, and they talk about how embarrassingly conventional models are horrible at dealing with recession calls. They never make a recession call, basically.
Yeah.
And the IMF did a study, a 63-country study, and the record of failure to forecast a recession is virtually unblemished. That's the punchline of their quote. So then the Economist says, oh, but check out ECRI. They're different. And at this point, it was pre-Great Recession, they said these guys called the last 3 recessions, and even more impressively, they've never made a false alarm. Never say never, right? I mean, you could be good at something and you're still not going to be perfect. So in 2012, we have this recession call on. And in retrospect, unless the data gets more revised, there was no recession. What we do have, looking at the data, in hand, is the second half of 2012 has a quarter of 1% GDP growth for 6 months.
Yeah.
So that's as close as you can get, pretty much, without going negative. That's what we had. So we had the direction right. Remember I said that directional call is the key. We had the direction right. Magnitude's a secondary function, and here we just missed it. But mind you, that gave you Qternity. So the story that everyone believes is that, the Fed got rid of a recession. I don't think that's true. I've done a big postmortem on this, and our whole team has, Anirvan and the team. And if the Fed had effected a dodge of a recession, then I think the most likely way that they may have done that, because they were already at zero, was by goosing equity prices, which they had said we want to target. Okay, so far so good. The story holds up so far. But when you look at the kind of deviations in stock prices relative to their past performance, it wasn't that big of a deviation. It was a 6-year deviation, 6-year high. It wasn't much.
Yeah.
Okay, but if you look for what was off the charts at that point, what we had, which was off the charts in 2012 into 2013, was a collapse in cyclical volatility. So remember I said that you have accelerations, decelerations, and growth. So typically that's like that, and just to make a picture, it got like this, right? So the downturn was so not volatile, right, that it just skirted right there in 2012 at 0.25% GDP growth for half a year. And when we look into what was going on there that could affect it, when you look at how all the recessions have been created over the last few decades, it's a cycle tightening, Fed cycle tightening, and an energy spike.
Yep.
That combination gets you. So we're looking at some BP work, British Petroleum work, and they found that the volatility of oil prices had collapsed in that period to the lowest it had been since prices were fixed in the 70s.
Right.
This was around a little over 90 to 100 bucks.
Yeah.
And that, when we think about it, we're like, how could that happen? That was Arab Spring, all kinds of Egypt, all these things are happening around oil, where you think a supply disruption might make an impact on oil price volatility. But fracking coming on was replacing that supply that was coming off from abroad, barrel for barrel, literally, virtually, literally.
Yeah.
So unless the Fed, unless their idea was, hey, we're going to put rates low and do easy money so that we can finance the frackers so that they can replace the oil supply that is going to be taken out by the, and I don't give them that much credit.
No.
So I think it was, we were lucky in the country in a sense that at that point, lucky to dodge a recession. But on the other hand, I think maybe we weren't, because I get worried that intervention there, the idea that a recession is Armageddon, the end of the world, and we should just do everything in the world possible to never, that's, first of all, there's one that's going to come, and all the unintended things that happen by virtue of trying to avoid one just make things worse.
I'm so glad you said that, because this has been my big problem for a number of years now. When did a recession become something we have to avoid at all costs? No matter what happens, we have to avoid a recession. These are perfectly normal events. They're perfectly normal cyclical events, i.e. they come and they go. They always have done, and they always will do. So, in some ways, I listen to that story and I think, the worst thing in the world to happen would be that, because the Fed, if they do think that they managed to avoid the recession, that just emboldens them next time to believe, hey, we can stave this thing off.
Yeah, so you fast forward to right now. What's going on right now? We got a growth rate cycle upturn, some inflation, underlying inflation stuff turned up last year. So it's about as good as it's going to get for a central bank that wants to tighten and think that things are normal. So they tighten, and unemployment rate's down. Phillips curve orthodoxy makes them go. So they're tightening, and they want to tighten so that they have room to ease later. first off, they're not going to get too far,
No.
right? And we already talked about global industrial downturn. Tightening into a global industrial downturn, probably not a good idea. And so then you have the downturn at some point. We don't have a recession this year, but I can't see into 18 that well. So it could certainly be there, all right? Now, what happens if you think that you can stave off recession as a central banker? Yeah, you're going to cut rates, and then you're going to say, well, we could do a different kind of QE, or maybe we could just do it bigger, or all of these things. And the unintended consequences just pile up. And I'll remind everybody that while we're not Japan, that we're structurally very different than Japan, Japan has been doing this longer than us. They've done all of this stuff. And they've had 4 recessions after the Great Recession.
Yep.
Okay, Japan even had a recession that nobody acknowledged. It happened. It was a recession. The stock market went down 5%, and then they said in their version of QE, let's buy the stock market.
Yep.
Okay, so but that's not free market capitalism anymore. This is now we're
a long way past that.
We're in a different place. And what do they do next time? I mean, here they've had 4 recessions. Okay, that's one thing that's happened. Even though they're at the point of actually grabbing equities, you've had very frequent returns to recession right there. And, you know, for those who say, oh, it doesn't matter, GDP per capita looks okay, actually not so good, right? If you look at the last 3 years, you get it through 2015, you can get it, the 3-year average, it's 0. Mm-hmm. I don't want to be Japan. No. I don't think any of us want to be Japan. I don't think that should be a goal. That's seriously lowering the bar.
but I think in many ways we all are Japan.
We are.
We're different shades of Japan.
Different reasons, different shades, but we are headed in that direction. Yeah.
I mean, when you look back at this data, and I'm fascinated to know if you see an effect of any kind that the extreme monetary policy we've seen, has it disrupted those cycles? When you look back,
no.
Right, which is extraordinary, because that's the sense I'm getting from listening to you.
No. Look, the business cycle is bigger.
Yeah.
Than the president. It's bigger than the central bank.
Well, maybe not the president.
Yeah. Now I'm in trouble. But look, you know, they're along for the ride, and the Fed, their tool is a cyclical tool. Typically, you raise or lower, and you impact the next couple of quarters. Now, if you do that for years on end, now you get into weirdness, okay? Yeah. Because companies that should have gone out of business don't. Investments that shouldn't have been made do get made. And you are going to have weird allocations of capital and capacity that you don't really need. So right now, everybody's waiting for business investment. We'll get a little bit. Okay, so we'll get a little bit. Are we going to get a game changer amount? Absolutely not. And the reason is companies have cash, sure. That's one thing they need. They have confidence, well, they had it, and they're kind of trying to hang on to it, and we'll see what happens, right? But the third thing you need is a constraint on your capacity. They don't have that at all.
No.
And if the capacity gets constrained a little bit, you know, okay, I'll ask my employees to work a little longer. That's all I'll do.
Yeah.
I'm not going to take a bigger risk than that. What will I do if I have a lot of money? I'll do a share buyback. I'll pay a dividend. I'll do M&A. All these things that probably help management get paid more.
Yeah. When you talk to someone like you that works with these cycles and has that trust in them, you know, I think everybody who looks at markets through whatever lens they have assumes that in the age of central banking from 2009, or you can take it back to Greenspan if you want, but let's talk about coordinated central bank intervention from every central bank on the face of the earth. You assume that those actions have had a major effect on what's happened in the world and by definition the business cycle. But what you're saying is, you know, it hasn't really changed anything.
No, to the contrary, and this gets a little complicated here, so I apologize for a moment.
Go for it.
21st century is different. Okay, and there's a few key differences. One is that the frequency of fluctuations is actually increasing a bit, which isn't necessarily a good thing, right? And in the increasing of the accelerations and decelerations, the frequency of them, the downswings are actually relatively longer than the upswings.
Yep.
Also not a great thing. All of this is consistent with the structural down push on growth that we've been talking about since '08, before Summers started talking about it. Now, when we look at that, that's happening in the developed world. That's also happening in the developing world. As I mentioned, Japan had 4 recessions since the financial crisis. I don't think people really realize that. Another thing that's occurring in the 21st century is that inflation cycles, which are related to but different than cycles in growth, have actually started to sync up internationally. They used to be kind of out of sync. Now they're kind of going like this. That's different.
Yeah.
And it suggests to me that these central banks actually have less control, if anything, than more control over what's going on with the cycle. So the really kind of scary thing that could happen is if volatility, economic cycle volatility picks up a little bit, and you add that to more frequent cycles and low altitude, then that is Japan. And if Japan is prologue, right, then you have 4 recessions in a handful of years. That's different than what people are used to.
Yeah.
And it gives you a lot of whiplash and a lot of confusion and a lot of angst. Okay, and so we talk about these big things that are going on. The baby boomers have basically been witness to this, rise of the East and give back of the Western dominance of the world. And then you throw this kind of stuff on top. It's unnerving. It's not what you bought into. It's not what you were told the way things should be. You want a simple answer. There actually isn't one. I would just point everybody to anything that would increase productivity growth.
Yeah.
Anything that would possibly do that would be super, super helpful.
So if you look back at '08 and '09 and let's try and strip out the systemic risk of the banking system contagion, et cetera, et cetera. Do your models give you a sense of what would have happened had they done nothing? Had they maybe cut rates a little bit? So what would that have looked like?
Well, I think it would have looked like, look, the cycle turns.
Right.
If you leave a free market economy alone and do nothing, pre-Fed there were cycles. Yeah. It's not like so.
And they were shorter and they were more condensed, but
there were some shorter and some longer. But like it's like you had a number of depressions before the Great Depression, and some of them where they did nothing.
Yes.
And you had very sharp recovery. In the Depression itself, you actually had some pretty strong recovery cyclically in growth terms that I don't think people realize. So the cycle will turn if you actually left it alone. I'm not suggesting that we're ever going to get to that extreme again, but if you went back to the idea that a central bank may do some counter-cyclical measures, much the way unemployment does counter-cyclical, right? So you lose your job. Instead of your income going to zero, it goes to a very low level, but you're able to have some consumption. That's an automatic stabilizer right there. The Fed's doing something like that. It's kind of taking off some of the extremes, but it's not saying that they're going to attempt to not have a cycle.
Right.
And when you attempt to not have a cycle, you're subverting all kinds of things that are very cathartic and important to future growth. So I think that if they had done kind of basic stuff without going to unconventional stuff, that we probably would have had a recession, and then we would have had a recovery. I have no doubt about that. It wasn't like the world was going to end.
Right, right. But this is really important for people to understand, because that was the narrative. That was the narrative through which they got a lot of this stuff done. Was it, if we don't do this, the world's basically going to end?
You know, I don't know exactly how this happened. I don't ascribe it to any one person, but there is, you know, there's like maybe, you know, there was this moment when Greenspan was the maestro. He was a rock star, right? And that probably felt good at the time.
I'm sure.
Right, and so central bankers, we all hang on their every word and all that, and they want to kind of remain relevant. And I think there are times when they have to stop, and you know they've done what they can do cyclically. And then if you want to do something about structural issues, so oversimplifying, just keeping it super simple, demographics, right? They're kind of low, and productivity growth is low, and if we could do anything to boost either of those, that would help our growth potential. Central bank can't do anything there. All right, they cannot do anything about those things. That's fiscal. That's the country's policy. What's the rule? What's our economy? How's it set up? Where do we want to try to improve these things? And that's a completely different discussion for different policymakers. But you know how that is. We don't even have that discussion.
No, we don't. And in many ways we can't.
We can't.
So how do you how do you solve a problem like Maria? How do you explain Australia? You know, here's a place that we're 26
They have
years.
a good central bank.
That's
one of the things I explained.
Well, this is interesting then, because you know we're talking about a country, for those people watching that don't understand what my reference. 26 years without a recession, I think it is now. Yeah, from a cycle point of view,
that's perfectly reasonable.
So let's talk about.
There's no rule that you have to have.
No, absolutely.
Right, yeah,
but it's out of sync with the rest of the world.
They've had fluctuations.
Yep.
They did things like when they had a surplus. Well, one of the reasons they do this is because when they had a surplus, they didn't just do a tax break and spend it all. Right? They said, "Oh, let's save this for a rainy day," and the rainy day came, and they were able to kind of manage through that. They also have a pretty cyclically savvy central bank.
I guess if you're a commodity country, you kind of have to be.
Well, yeah. Otherwise, you got to get out of the business.
Yeah.
All right. I mean, if your business, so commodities very quickly, those are tied to the industrial cycle. The industrial cycle is the most cyclical component of a free market economy. So you absolutely want to be on the right side of that. And what you can really do, I think Australia's also been a little lucky. They've done some stuff with China.
For sure.
So I don't want to downplay the factor of luck.
I think
it's a big piece. But I think that what kind of understanding about the cycle, what can you do, right? What's the best you can hope to do? I think you can try to move a little preemptively as a central bank, because your tool, interest rates, which is the tool you have, works with long and variable lags. So if you're going to have any chance of influencing the cycle a little bit, you got to be proactive, not reactive. If you're reactive, if anything, you might make the cycle bigger. So here that's why I think they're kind of cyclically savvy. I think they are attuned to leading indicators and willing to go a little bit against what the consensus view might be around some of the cyclical peaks and troughs in a way that may smooth the business cycle. I'm reminded of, this is old history now, but it was a great quote from the late Senator Patrick Moynihan, who was being interviewed by Sir David Frost about what is mankind's best achievement. It was something to this effect. So, they had a better question, but it was I'm paraphrasing, and I kind of thought he'd say like plumbing, indoor plumbing, or something in his lifetime, right? And he was greatly influenced by the Depression, and so his answer was the taming of the business cycle. This was pre-Great Recession.
Yep.
But in his experience, which was, very much influenced by the Great Depression, and this is pre-Great Recession, he was saying, the taming of the business cycle in the West, that was the greatest thing, because, you have no idea what it was like.
Right.
These crazy swings. And these are all like pikers compared to that.
Yeah.
And the quality, there's a lot of collateral damage around big cycle turns. for those who are more vulnerable.
Sure.
Having those relatively mild recessions that most people were used to until the Great Recession might have lulled them into a little bit of fear. And maybe that explains the central bank freakout to a degree. They've never seen anything like that. And therefore, recession became something to be avoided at all costs. I think that's a mistake.
Yeah, I couldn't agree more. You know, I look at Australia, and you're right. I think they've surprised the market more often than most, which tells you that they are a proactive central bank. But I don't see that anywhere else. I don't see any other central banks.
There's a new one. There's a new one. You have, I'd say, the Reserve Bank of India.
Okay,
they've just set up, a little while ago, an MPC, a Monetary Policy Committee, mirrored on the Bank of England. And they've actually cited equities indicators in some of their policies, including around demonetization and holding the line when others thought, oh my gosh, it's going to collapse here. But they were watching the forward indicators, which were not showing any collapse, and they held their ground. And it'll be interesting to see how that evolves, because they're certainly going to have cycles, and they're doing a big structural move there. But I would keep an eye on the RBI alongside Australia.
Okay.
Going forward.
That's interesting. So coming back to, because we're going to run out of time soon, but coming back to the US, because that's kind of the recession that everybody now is looking at. Because as goes that, so goes pretty much the rest of the world. Just run us through what you're seeing, what you're either concerned about or relaxed about, and give people a picture of where we are in that cycle.
Okay, no recession this year. Overall economy is still in a growth rate cycle upturn that began in 2016.
And just if you can flesh out what that actually means, the growth rate cycle upturn.
So the growth rate cycle upturn means GDP, jobs, sales, broad sales measures, and income will rise. The growth rates of those together will continue to rise. They bottomed in 2016, the lowest growth rates, and collectively they're rising, and they will continue to rise in this year. I don't think they're going to stop rising this year. That acceleration, growth rate cycle upturn is going to continue for the overall economy. When we look at sectors, it's very much the service sector that's driving it.
Yeah.
Construction's helping also. And manufacturing, which had a very clear recovery out of its earlier recession, had been powering this, but that's now peeling off. And the manufacturing sector is starting, I believe, is just about to turn down in the United States. And the growth rates there will be coming off. But services and others are going to keep the overall economy continuing to grow. So the thing I worry about is what's going on with manufacturing. And that ties in very closely to the broader global industrial growth cycle, which we've been expecting to turn down based on our global industrial indicators. And that global industrial downturn, I think, is already happening. And the US downturn is part of that.
Yep.
Basically, all of the manufacturing sectors around the world are linked pretty much together. It's very hard for one to de-link. So they're all in this together. And that is in the relatively early stages. That is, we have a lot more. You're going to be hearing about the global industrial downturn in the next couple of quarters. And so the mix that gets a little interesting, there's two things. One is you got bank tightening into a global industrial downturn, maybe ECB, certainly the US, and that probably won't help the global industrial downturn. And the other thing is that more often than not, an industrial sector downturn, it's a more cyclical component of the economy, eventually spreads to other sectors of the economy. So right now we're very closely watching, is it when, we expect it probably will, when does it spread to the broader economy, leading indicators, and that'll be the sign of something maybe in 2018.
Right. But you're comfortable saying nothing this year. We're good.
I don't think any recession this year, and the reason is, the reason I'm comfortable saying that is, it's not that I don't think there won't be any shocks.
Right.
Right. There's shock every day you walk out the door. There's a shock. Okay, so there's shocks are probably likely, but the thing is, they're always kind of likely. If you think back, there's never a shock-free time.
No.
But many conventional kind of economists thinking would be recessions are caused by shocks. Well, that's kind of a convenient out, right? Because the models won't predict a recession. So when the recession does come, they just look around, whatever shock it was, they go, oh, that was that fault. That's an easy out. That's not how it works. The way it really works is that these leading indicators, when they turn down in a recessionary way, a window of vulnerability opens up, and any shock is recessionary, virtually any shock. If the leading indicators haven't rolled over, they're still going this way, the window is closed. You can have the shock, but it can't get through.
Yeah.
It's not recessionary.
Well, look, this is...
There you go.
Hey, that's optimistic.
Okay.
It's good
so
to
it's optimistic for
the next 6, 7,
quarters.
8 months. Yeah, which is
Couple quarters. I wouldn't even go 8.
Well,
I'll say 2017.
Good. Listen, I'll take 6 months of optimism. That's great. Lakshman, thanks so much. This has been a lot of fun.
Me too. Thank you.